All right, Zynga, it's the biggest maker of games on Facebook, and Zynga could soon go public. The company is seeking as much as $1 billion in an initial public offering. Now, the idea is to sell 100 million shares at $10 each. Let's find out more about the IPO world. My guests are Scott Kessler, Internet Equity Analyst at Standard & Poor's Capital IQ. And also with us, we have Bloomberg News reporter Lee Spears. He covers the initial public offering market. Gentlemen, good to have you with us. Scott Kessler, start us off. What's the health of the IPO market specifically when it comes to technology companies right now?
Well, Pim, thanks a lot for having me on. I'd say there are good and bad aspects right now to the technology or internet IPO market. On one hand, it seems like you have a lot of companies interested in coming public, and they're capturing some pretty significant proceeds from their offerings. On the other hand, it seems like the valuations for some of these companies has actually been going down as they transition from private markets to public markets, and the stocks in the public markets have not been performing especially well.
Lee Spears, come in on this, because as Scott mentions, if you take a look at the current price of many initial public offerings, post the public offering, I'm thinking here of Angie's List and maybe even Groupon, you're not seeing this continued investor appetite for these shares. Is that normal?
Is it normal? Well, it's certainly something that's surprising people a little bit. Yeah, you named Angie's List. You see Groupon, Pandora Media, LinkedIn to a lesser extent. They've come off. LinkedIn, of the ones I named, is the only one that's still above its initial offer price. So all these other companies have actually lost value for people who bought them in the IPO, let alone anybody who bought them in the secondary market after they were public. You know, those people have lost even more.
What characterizes Zynga that might be different from some of these other companies? We were just talking about the statement having to do with their sales. Was it $375 million for the last quarter?
Right, yeah. Well, the thing that's really different from Zynga, I think people are really going to focus on for this offering, is that they're not trying to sort of game and jig the structure of the offering with an ultra-low float to boost the valuation. That's something that Groupon did, something that LinkedIn did. I'm talking about offerings that are floating less than 10% of their shares.
In other words, you sell very few shares. That kind of constrains the market. You can't short the shares, of course, because they're too expensive to borrow. But that means that there are not a lot of shares out there to actually buy
exactly.
Anyway.
It's a manipulation of the supply and demand dynamics. So if Zynga is actually making about 14% of their shares public in the IPO, and I think people are going to look at that. What it means is Zynga is not pushing valuation the way a lot of these other companies have done. And they probably have to do it given the fact that a lot of these social media internet companies have not performed well in the public market.
Well, you mentioned social media companies. Scott Kessler, I want to get your thoughts on the possibility of a Facebook initial public offering. Is there some connection between, let's say, the potential success of what happens to Zynga and the ability of Facebook to go public at what? There have been some estimates, $100 billion valuation?
Right, Pim, there definitely is a connection, but to be totally honest, we don't think the folks at Facebook are, let's say, going to be glued to their monitors and TV screens in the coming weeks to find out when Zynga will price, how it fares in the aftermarket. The reality is that Facebook is a special kind of company, and we think they could probably come public no matter what the environment is, if they wanted to do so. You know, we think back to when eBay came public in 1998 during the Asian currency crisis, right? Or PayPal when they came public in 2002. These are companies that were sought after, that had really strong, differentiated, exciting franchises. The market didn't dictate when they came public. The companies did. We think that'll be the case for a company like Facebook as well.
Lee Spears, who are the investment bankers targeting when they offer up the shares of these companies? Is it the retail investor, or are they going after institutions and mutual fund investors?
In an offering like this, it's a social media offering. When you talk about a Zynga or a Facebook, it's a company everybody knows who they are, and a lot of people use their products every single day. So in these cases, they're probably going to target the retail investors a little bit more. You know, so one person suggested look at the per share price for Zynga. It's $8.50 to $10 a share. You know, that's kind of that's almost an attainable price for a share.
So they price the shares in order to entice certain groups of potential potential shareholders.
I'm sure that's part of the calculus that goes into it. Yeah, I mean, still, the bulk of the offering is going to go to institutional buyers.
All right, I want to thank you very much. Lee Spears from Bloomberg News shedding some light on the initial public offering market, particularly on Zynga, and Scott Kessler joining us from Standard & Poor's Capital IQ, giving us a take on the health of the IPO market.